I Still an Opening from Ben Shapiro. Tina Tambor in the Crop Report reports on how crazy it is out there. And then later on, I'm going to show you how to destroy the Western banking system on today's Unnamed Real Estate Podcast. It's May 27th, 2021, and this is episode 17. Today, as I plugged right now, we're going to be discussing the latest Cromford Report details that Tina Tambor talked about on Security Title's conference call. And we're going to go over this week's numbers that I pulled on Wednesday. And then I'm going to finish up with a conversation about paying off loans early to destroy Western banking. All right. Hope you guys find this one enjoyable. Now the numbers for May 26, 2021. Our actives as of this morning were 4,544, up 40 from the week before, continuing that slow growth range. Our pendings were at 2,006, which is down 59, and our closed were at 2,495, which is down 12 from the week before. Our under contracts looking for backup is 1,274, which is down 45, and our ones with buyer's contingency on the sale of their own property are at 82, pretty much staying right in that low 80 mark we've been seeing from the beginning. We're also looking at coming soon, sitting at about 1,000 a week. We're at 1,007 this time around. One of the things I wanted to follow up with is we had a Cromford Report come out this week, and I snagged a couple slides from it. Showing here, and this is her wrap-up summary slide, what's going on. All right, but the seller market is starting to weaken. We are seeing buyers are actually starting to back off in their interest, and I will show you that on this slide right here. If I can find it right. Oh, we'll just continue on with this right now. Supply is still low. It's at 76% below normal seasonal level. All right. We are averaging about 2,367 new listings every week, and the supply is actually up by 14% since mid-February, but it's still down 59% from this time last year. But remember, this time last year we were also dealing with the COVID surge, where a whole bunch of properties fell out of contract, got put back on the market, so that number's a bit inflated. Our demand is actually starting to come down a bit. We're only 7.5 above normal seasonal level, which is coming down from the peak that we had earlier this year. So more buyers are getting discouraged. Interest rates are starting to affect who can afford to buy, and we see things are starting to come down. The big numbers that we're looking at that's affecting everything is that 58.5% of all the April sales were closed over asking price. The median over asking price is $17,000 on that. Remember, median is not average. Median just means that 50% of all the properties are on one side of that number and 50% is on the other. All right, and our days listed prior to contract is we're going 6 days. And this hasn't changed in the last 9 weeks. We are still appreciating. Our May appreciation is looking at 40% so far, and that's something that's going to fluctuate. So, that's not a hard number to take into effect. And this is being affected a lot by the unemployment report. We're unchanged at 6.7%, but 71% of all Arizona jobs have recovered since the pandemic. Labor force is growing by 11. So even though we have our unemployment rate at 6.7, the fact that our labor force is growing means that more people are working, even if you don't see the unemployment number change itself. And the big growth there has been in trade, transportation, and utilities, where they've had 136% of the jobs recovered. So they have made up the COVID loss, and they're continuing on. Cash sales and inflation. All right, we're at the normal percentage for cash sales right now, which is running right at about 23%. All right, and we're seeing the total number of them being higher because we are actually having higher closings going on right now. So the other number that I wanted to show you on this chart, if I can pull it up real quick, is going back to closing per month and how much is actually going above list price. This is from the Cromford Report themselves, and right now here's your 58.7% median, right, or of houses that are closing above list price. And you can see down here where the majority of our closings are in the 300 to 400 range. All right, that's the bulk. And of those, 67%, all right, so over 2 out of 3 of them are closing above list price. And if we scroll down here, we can see the list price ranges, and this will break down actually the median amount, right? And from the 300 to 400, 50% of the sales, all right, were over 50% were 16,000 or less over list. Now, just break that down. That means of the ones that do go over list price, over the asking price, right? Of that 67%, the median number on that was 16,000. When you get up to the 400 range, you see it go to 20 and all the way up until you start playing over with the rich people, all right, where the houses that were selling over, okay, they were on an average 100, or median was 150 on that. But for you people down here who are just trying to buy your normal 3.2 in the 250 to 400 range, right around here, you're looking at a 15 to a 16 median over. And in that price point, somebody actually went $105,000 over whatever the asking price. I'd love to know what that property was and how that worked out. This is actually reflecting the same numbers that I'm seeing. When I show a house, if an offer is made on, if we don't get the offer accepted, I save that and I go back and look at it, and that seems to be the price point. 2 of those houses actually went for $25,000 over. I had ran into an old friend who was actually sitting on one of her listings. So after it came off, I sent her a text and say, hey, just for my own knowledge, what did it go for? She had that property listed at $320. And for a property that was listed at $320, they wound up accepting the offer at $340, where the appraisal was waived and they had reduced the inspection period to 5 days. That was not the highest offer they got. They actually got an offer for $370, but that $370 offer did not have an appraisal contingency, and they were not offering to pony any money up if the appraisal was missed. And so that's just somebody who's just trying to buy the contract and hoping the appraisal will come saving. And that agent is a very smart agent. I trained her myself, and she saw the trap when it came in, and that's why she advised her client not to accept the bigger price tag, right? Because it did not have the conditions to make it a really, really good offer. See the episode I did really early on, the elements of an offer. So this is what our numbers are looking at right now. And what I'm seeing that's coming across, I think I had all of the highlights that I wanted to go. We are seeing listings with price reductions out there are starting to go up, and that's might just be people who are overemphasizing. Okay, they're hearing houses are going up 20, 30 over asking, so they come in 20, 30 over asking, or what they should have been properly listed at, and then eventually need to start coming back. And remember, when you say a price reduction, you reduce your price by $1, and you're going to get that price reduced tag on your listing, and it's going to pop back up on everybody's thing. And some agents actually use that as a marketing technique, is that they'll just drop the price by $100 every weekend or every day just to keep that tag going on that. So something you need to know. So, and that's the end with these numbers. Thank you very much. Have a great day. So now that you have the loan, you have the house, most people today are buying houses with a loan. And some people are paying off cash, but you might want to refinance out, pull some of that cash out. Regardless, majority of homeowners are going to wind up with a mortgage. And your average mortgage is a 30-year loan with a fixed interest rate. And what this does is it actually locks in your monthly payment that you're going to be doing for your mortgage. Now, remember, your mortgage payment is generally made up of 4 elements. All right? Your first element, principal. Second element is going to be the interest that you're going to be paying. The principal is the amount that you owe that's actually paying back the debt. The interest is the money that you're paying to have that loan. And then you have taxes and insurance on the end of that. So today, all these numbers are going to deal just with the principals and interest. Now, when you get the loan, you're going to get this, most lenders are going to give you this big chart called an amortization table. And what that does is it shows you that your first couple payments that you make is going to be relatively low on the principal side, but your interest is going to be high, but you're still going to be paying a flat rate. As you slowly pay down your principal, right, your interest amount that you're paying is going to get smaller, right, and your principal payment, it becomes more of that overall payment. So I'm going to show you something, a way to lower your overall interest that you pay over the life of your loan, and shorten the length that you have that loan open. So look down at the very bottom of the screen right underneath my face, and you'll see that it says Ray is just a real estate agent. You should be talking to your financial advisors. Everybody's situation is different, right? This is not advice from me, right? This is just showing you the mechanisms and the tools to decide whether or not this might be a good idea from you. All right, legal disclaimer aside, attorneys are happy, brokers happy if you just watch this. So let's go on with the rest of this conversation. All right. So let's say you just took yourself out a $300,000 loan to buy this property. Right. Probably put some more money down on top of it. VA loan, maybe you didn't need to come in with anything. Maybe you had a buyer's assistance program, but you have a $300,000 loan right now. Right? And at today's market rates, that's about a 3% interest on that. So $300,000 at 3% interest over 30 years or 360 months, all right, would give you a payment of $1,264.81 to cover your principal and interest. Now, you can do these numbers yourself. Right down at the bottom, I've estimated all this from a place called bankrate.com. All right, we'll put a link in the show notes. You don't have to follow along or anything like that, but you can start punching in your own numbers, your own loan, your own interest rate, and see if this is going to work out for you. All right. So with that loan, $300,000, 3% interest, if you took that out today, started making your payments of $1,264.81, you'll have that paid off on May the 27th of 2051. That is your home purchase loan. So let's say we take this exact same loan. All right, now this is a 30-year loan. You can also get 15-year loans. You can get 20-year loans. These will increase your payment amount because you will be paying more of that principal, because now you have to pay off this loan in 15 years and not just in over 30 years. Right? Those make your payments higher, but you pay less overall. Because of this loan right here, over the life of the loan, you're going to be paying $155,332.40 in interest while you pay off the $300,000 loan. All right, for a grand total of $455,332.40. Right, clear as mud? Let's go to the next step. Let's take this exact same loan, $300,000 at 3% interest over a 30-year mortgage. But instead of making the $1,264.81 payment, you roll that up, and now you're going to be paying $1,500, $1,500, or $235.19 more to make that nice round number. What does this do to your loan? What this does to your loan is, because you're paying off the principal quicker, there's not money in your loan to gain interest on that you would have to pay off. So you wind up paying less interest. You wind up paying $116,408.10, or a difference of $38,924.22. But wait, there's more. Because what also happens is that loan that was originally getting paid off in 2051 will be paid off July 27th of 2044. That's over six-year difference. So you're getting the loan paid off quicker. And this is important to some people who are, looking at, are we retiring in 30 years? Do we want to get this paid off? Because let me tell you what, these interest rates at 3%, these are seriously historically low. We've been covering this in the last episodes. All right, there's a chance if you refinance out in the future. And now, I don't have a crystal ball, I don't have a Ouija board, I don't have a magic 8 ball. All right, but I'd be willing to put dollars to donuts right now that in the next couple of years, these interest rates are going to go up. So if you were to refinance out later on, you'd be paying a higher interest rate. So you might want to keep this loan going. All right, once again, what I said before, I'm not your financial advisor. I'm just giving you tools. You need to make these decisions. So to have this loan paid off in 2044 and not 2051 and pay less interest on it, plus earning more equity in your house, or having more equity in your house over the life of your loan. This is a simple rounding up. You are still going to wind up paying up the $300,000. You're just paying it quicker. So once again, I'm just a real estate agent. All right, you should be talking to your financial advisors on this. But what does this do overall, and how does this destroy the Western banking system? The majority of loans that you will get, and they will be clearly disclosed on your disclosure forms, all right, there is no prepayment penalty, which means they're not going to come after you for more money. I've seen it written in loans before, usually from third-party lenders or seller carrybacks, where if you wind up selling the house, paying the loan off early, they're going to charge you like an extra 5-10% or something like that. All right. There's no prepayment penalty. There's nothing wrong with that. But that loan that you just took out from, ABC Bank to buy your house is going to be sold to a third party. All right, Fannie Mae, Freddie Mac, REITs, whatever. Somebody's going to come in there and buy that to recapitalize the bank so they can lend more money out. We've talked about this before. The bank that is purchasing your loan is expecting to get the $155,000, whatever, in interest for the money that they're ponying up. If everybody who had a loan out there did this and paid their loans off earlier, it would seriously affect the way we do banking today. Right? Bankers, accountants, the markets do not like change. They do not like uncertainty. That's what makes them really twitchy. When they purchase a loan, they want to know that for their $300,000, they're going to be getting $155,000 in interest back. Right? So that's why I'm only, I'm joking, but I'm not joking. Right? If everybody did this, banks would be in a really bad place. So don't everybody go out and do this, all right? Talk to your financial advisor and see if this is right to you, all right? But this is a way you wind up saving money on your house overall, having more for you, all right? Hopefully you're squirreling that away and be in a better position 30 years down the road. So I hope you found this all coherent, and I hope you all found it informational, and I hope you guys are all going to have a really great day. Thank you much.